Well, hi traders, Chris from the research team here at Pepperstone. Now, in light of the weaker non-farm payrolls number that we saw in the US on Friday, I've had a number of calls from clients talking about, asking the question, where to for the US dollar? Are the risks skewed lower? Do we expect to see another bear leg lower coming forward? And I think that's where the probabilities certainly lie. Certainly upside rallies have been well contained. And I think if we were to see a break on the dollar index of 97.65, the range lows, obviously that would perpetuate the selling coming through. If we saw a push through 117.40 on euro dollar, which has sort of capped the rate recent rallies, I think again that takes us into 118, potentially up as high as 120. Dollar Swiss looks weak, and we're seeing some good selling in dollar renminbi at the moment. And Aussie dollar looks like it wants to take into the top end of that year-to-date high around 66 cents. So certainly something we are watching as well. Now, there's a number of factors that I look at when we're making these sort of calls about where currencies could go. Obviously, price is true, but we're looking at relative rate settings, interest rate settings, relative growth, and relative policy uncertainty settings as well. And I think that will sort of manifest into some of the flow data that we're likely to see. We're talking about hedging ratios from the slower moving asset managers, the insurance companies, the pension funds, those liability funds, which are a lot slower to manifest and move those hedging ratios. And that's still yet to come, probably likely early Q4. And then that will coincide with probably systematic trend following funds selling dollar futures, and obviously some of the specky funds looking to ride that down as well. And that's still yet to come, and that could really accelerate the selling when it does. But obviously continue to watch in those technicals. Now, from a relative rate perspective, obviously the weak payrolls number that we saw has opened the door to a 50 basis point cut. I still think a 25 basis point cut from the Fed in September is the default setting. But if we get a benign PPI and CPI print in the US this week, obviously that does increase the chance then that the rates market will increase their probability for a 50 basis point cut in September to around 30%. And obviously that will take the US dollar lower. We're also seeing what we call the terminal pricing, where the market sees the low point in the Fed's cutting cycle around 2.90. So that's just below where the Fed see their sort of long run rate of 3%. So that's getting into the idea that the Fed may need to stimulate. If that terminal rate pricing comes down to 275, it's a little lower. I think the dollar takes a leg lower in that situation as well. Now, obviously, the ECB looking like they're probably done cutting, or looking like they're nearly done cutting. The Bank of England pretty much there. The RBA is suggesting that maybe we could see two cuts. I think maybe one. Relative rates favour selling US dollars. Relative growth rates, certainly, we're seeing the US slow down. Obviously, the labour market's a big issue there, whereas the rest of the world is slowly creeping up. And in policy uncertainty, very much in favour of selling dollars. So from a flow-based perspective, from relative growth, I think we're probably likely to see the next leg of the US dollar lower. We'll have to see how it goes and trade at Pepperstone.